Well, good afternoon and welcome everyone to our session on business leadership in the 21st century. Peter Drucker defined management as doing things right, leadership is doing the right things. Well, what does it mean to do the right things, particularly coming out of a global recession? What are the right things in terms of economic growth, in terms of dealing with employment, dealing with the key issues of climate change, food security, and other areas that businesses are called upon to engage in? And last year, when we were here together, governments were looked upon as being the last line of defense at a critical time economically. And business seemed to be playing a lesser role. Now we're seeing the constraints on government fiscally. We're seeing the constraints on government's agreements, such as at Copenhagen. And so the issue of the relationship between governments and business in trying to solve these broader issues is perhaps more complex and yet more important than ever. We have a great panel to discuss some of these issues here this afternoon. Stephen Green, chairman of HSBC, Rosabeth Kanter, celebrated author and professor of Harvard Business School, Indra Nooyi, chair and CEO of PepsiCo, Eric Schmidt, chairman of the executive committee and CEO of Google and co-chair of the 2010 annual meeting, and Wang, chair and CEO of China Mobile Communications. Welcome. Indra, on this challenge of working to solve not only economic but social issues and the relationship between governments and industry in trying to deal with these things, how are you seeing this emerging coming out of the global recession?
So let me provide some context and actually go back a little bit in history because I think it's important we put this whole issue in context. Let's go back to 2000, 2001 when we had the meltdown of Enron and WorldCom. Interestingly, when Enron and WorldCom ran into those issues, it didn't really bring down the economy, it didn't bring down a financial system, but it shook public's confidence in corporations and CEOs. And in anger, Washington passed Sarbanes-Oxley. It was passed hastily, but it was passed, and it brought some comfort to the public and said, maybe now corporations are fixed because Sarbanes-Oxley is going to take care of everything. The question is, did that help? Did that one act actually bring confidence back in companies? I'd like to say yes, because the amount of work that went into Sarbanes-Oxley was staggering. But unfortunately, Sarbanes-Oxley didn't prevent the financial meltdown we had in 2008 and 2009, because that brought the financial sector to the brink of a meltdown, forced governments to act rapidly, and inject a lot of money into the system. And what happened to a public that was always skeptical of corporations and CEOs, it actually shook their confidence completely. And the most depressing thing was to look at the Edelman Trust numbers and to see the CEOs rock bottom in that whole trust index. And for us hardworking people, that was a very tough position in that barometer to take on. And because of what happened last year, faith in corporations in particular is at an all-time low. Short term, there have been a lot of actions by governments, be it taxation on bonus, increased proxy disclosure, lots of negative attention on CEO pay, you name it. I mean, this is not a popular job to have these days. But governments have not acted in concert to implement anything sweeping, but the public is waiting for something to happen to regulate private enterprise and to rein in the financial sector. Whatever the outcome, I think we have to accept that the outlook and the future for CEOs and corporations post-2009 is going to be very, very different than life was before. But as we move forward, I want to keep a couple of facts in mind. Private enterprise is critical for economic development and growth because we create jobs, we spur innovation, we improve quality of life. Yet, if we're not pragmatically regulated, we can create problems too, as was evidenced by the last couple of years. But going forward, we in the private sector have to recognize that governments are going to play a bigger role in our life, in overseeing us and providing a lot more direction. And as a discussion in Davos last year and this year have indicated, and as all the editorials in newspapers, many books have been written about it, I think the nature of the enterprise, the nature of capitalism is going to change, whether it be capitalism 2.0 or 3.0. I think all companies are going to have to think long-term and not short-term. The focus has to be on the stakeholder, not the shareholder. And we have to marry performance, and purpose. And this is not new news. You know, corporations operate from a license, with a license from society, and we owe society a duty of care. But let's also be clear, corporations can't do it alone. We have to work in concert with governments, and governments need us to be the engines of growth, as I explained earlier. And this mutual interdependence means that public-private partnerships are absolutely critical going forward. Today, if you look at the environment, I wouldn't say that partnerships exist. I'd say there's a lot of skepticism and anger. But I suspect coming out of this short-term anger, you are going to see many more public-private partnerships emerge because governments can't do it alone, and we need government to work with us, not against us.
Well, and Indra, let me go forward on that point. This issue of trust, it's not really a challenge of trust with the public. It's actually a challenge of trust between the corporate sector and governments. And yet, as you were pointing out, this issue isn't just a relationship between governments and business on stopping bad things happening through regulations. It's how they actually work together to achieve some of the good things that need to be done. How do you see that challenge over the next couple of years?
Well, the question is, are we, the business sector, going to take the leadership and actually propose to governments a new way that we can operate so that government doesn't have to tell us how we should operate? Mm-hmm. And I'm not sure we, the business sector, are willing to come together and propose that framework. Were we to do that, then I think we could have really sort of chalked up marks on the board for the private sector. That's a challenge I'm throwing out to myself. Maybe it's foolish, but what the hell? That's
a great one. Well, and we'll come back to that when we talk with people in the audience. And Indra, you mentioned the issue of capitalism 2.0. Well, certainly in terms of some of the alternative models that we're seeing in the world today, one that's getting a lot of attention is the Chinese state-owned enterprise mixed model. Mr. Wang, your organization represents not only an extraordinarily successful organization and corporation, but also an example of an organization that's partly owned by the state, partly owned by the public through public share offerings. How do you see this issue of the role of the corporation in providing not only economic returns, but economic returns to society?
Yes, you're right. China Mobile is a listed company, and we have 25%.
You speak English so well. It's wonderful.
Oh, okay. I don't know what happened. Yeah.
It's amazing.
Okay. 25% are floating public investors, and 75% belong to the government. And first of all, I'd like to talk about the change of the business leadership before and after the crisis. I think the crisis gave big impact on business leadership, both for the private company and the public company. And I think there are two kinds of impact. One is tangible, the other is intangible. Take the example of China Mobile. It is a company with a subscriber base of 520 million. And the crisis gave us the big impact, for example, because of the decrease of the exports. It gave us the slowdown for our international calls because many migrant workers return to rural area. It decreased our growth also. But the situation of that is over. The migrant workers now go back to the cities, and we now have the international calls number equal to that before the crisis. But I think we still have some intangible impact on business leadership. The biggest one is there is the decline of the public trust in companies for the value creation. And you know, China Mobile is a big company in Hong Kong and New York, listed in Hong Kong and New York. And I think now the analysts don't know how to analyze a company after the crisis. And the investors don't know whether the analyst reports for a company are reliable. And for companies, for management team of company, we also complain that many people just pay attention to the news of company, even for some rumors of company. They don't pay attention for the financial results, for the performance, for long-term performance. Sometimes some rumors can affect the company's price a lot. So this is a big issue. This is the intangible impact because of the crisis. And I have 3 points of a proposal to deal with that. The first thing, currently, as the management team of a company, we should pay more attention to the real practice rather than the theoretical models. The bankers give us a lot of models, but they are based on the assumption. If the assumption changes, the result will be quite different. We should pay more attention to the real practice. Second, I think we need to use new technology. During the crisis, the management team just pay attention to the cash flow healthily. And now it's the time to use new technology to pay attention to technical innovation. And third one, company should take more social responsibility.
Well, thank you very much. So we're having a number of very concrete ideas here. Indra's proposal that business has a responsibility, necessity to engage more proactively on what they're going to do positively, rather than just what they oppose in terms of the regulatory area. Mr. Wang, you've laid out 3 issues, and let me come back to this one of being more responsible socially. And how do you, China Mobile, define that? And are there some concrete examples of the kind of social engagement that you see as critical to your raison d'etre beyond just economics?
Okay. Yes, I'll give you an example to how the mobile coverage in rural area. 5 years ago, when we did the coverage in rural area, I got a lot of warning from analysts. They said, never do that because you cannot get a financial return because very few people in rural area will use mobile phone. But we think it is the social responsibility. We should take the responsibility. But the problem is how to balance the social responsibility and the financial results, the value for shareholders. 5 years later, today, the situation is quite different. Because we have a very good coverage, the company becomes very, very competitive. It reduced the churn, and it attracts more subscribers both in rural areas and in cities.
Interesting. So actually addressing the social needs actually also helped over time improve your economic returns as well. Well, Stephen Green, we can't have a conversation on these kind of issues without, of course, looking at the financial industry. I'm going to shock and surprise you by asking you about the regulatory areas, but I think we're all interested in understanding beyond that. What do you think the role is of the financial industry in not only ensuring that the bad things of the past don't happen, but some of these really important good things in terms of growth and addressing some of these other social issues are actually effectively addressed?
Well, Robert, thank you. And I think the first thing to say is that everything that Indra has said about the corporate world in general, in terms of its issues of trust and confidence amongst the wider community, is true in spades of banks for all the obvious reasons. I remember being here last year, in fact, on a panel with Indra, at a time when it did seem as though the financial world was heading towards an abyss. I remember, I think Tony Blair was on the same panel, and he accused me, or complimented me, I suppose, as being one of the few bankers prepared to appear in daylight. It's at least true to say that we're in a better space now than we were then. Nevertheless, there are still major issues, clearly. There's been a huge breakdown in trust in the financial system. This is a breakdown in trust in the institutions and the way the system operates. It's also a more fundamental questioning of the very role of the markets and capitalist development itself. And the debate is furious and will continue for many months at least, actually I think probably for many years, about the implications of all this. Books are being written, more books will be written. And there are lots of lessons to be learned. One of the mistakes no banker should fall into making is of being seen to argue that somehow we've learned all the lessons, we've fixed our house, and now we're ready to move on and please stop beating us up. Because actually life is not as simple as that. It is true that a number of lessons have been learned. It is equally true that there's some way to go yet. I don't think we can, any of us, say that we've got a functioning financial system yet that is stable. Well, I think it's stable, but it isn't robust enough, and it isn't yet in a position where it's performing the proper role that it has in the context of economic and social development. I want to come back to that in a minute. The regulatory debate is both intense and intricate, and is complicated, as we all know, by political initiatives emerging on both sides of the Atlantic. I'm not going to suggest, unless you want me to, that we go into the details of that regulatory debate. Suffice it, I think, to say that out of this will come a better capitalized system, a more liquid system, a less geared system, and a number of other measures to strengthen its robustness. Because we really do need to ensure that we never again get into the position that the financial world put the real economy into in the years 2007, 8 and 9. So there's a long way to go on all of that. But what I'd like to do, with your permission, is kind of look beyond all of that for the moment to just reflect a little bit on what the role of banks and the financial system is. Longer term, and I start with a very simple proposition that there is no alternative to a financial system if you want viable social and economic development. It is very important that we don't throw the baby out with the bathwater. It is important that we don't forget that the financial system and the increasingly globalized capital markets have facilitated significant development in many emerging markets, which has led to hundreds of millions of people around the world being lifted out of poverty and given their real first chance of improving their lot in the mainstream of modern society. And these achievements need not to be forgotten. What we need to do is ask ourselves how we ensure that we get back to that role. And I think in essence, there's quite a simple answer to the question of what is the responsibility of the banks and the capital markets in all this. The answer is that we're there to contribute to economic and social development, and insofar as we do that successfully, we will have profitable businesses. I mean, we are banks, we are businesses and not NGOs. We need to make a profit for our shareholders, but we need to recognize that we will only have sustainable business models insofar as we are sustainably developing the position of our particular institutions in society. Sustainability, I think, is a key word to hang on to. Sustainability means at least three different levels of things. First of all, sustainable profits. Like I say, we're businesses, we're not charities. We need to have sustainably growing business models that are profitable and enable us to pay returns to shareholders. Returns to shareholders are sometimes treated as an optional extra, but actually the truth is that the people, the investors in a company like mine are pension funds on behalf of all sorts of people. We calculate roughly that there are some 17 million people whose pensions get paid directly or indirectly by dividends that come from us. So yes, this matters. But in order to get that sustainable flow of returns to investors, you need to have two other sustainable watchwords. The first has to do with people. It's a cliche in many businesses, but it's certainly true in banks, that the people are the real assets. And unless you engage your people and engage them over the long term, you're not going to have a sustainable business model. I don't want to be naive about that. Businesses change, you sometimes have to make hard decisions, but the fact is that unless you're investing in the people who do the business for the company, in this case a bank, you are not going to have a sustainable business model. And then the third thing that follows on from this and follows from it increasingly is a sustainable commitment to the communities in which we do our business. I say it follows from it because all of the evidence is, We, and no doubt my peers in the market, do the same thing. We do people engagement surveys for our people around the world. In our case, we employ some 300,000 people in 85 different countries. And those engagement surveys tell us the very strong importance to our colleagues, to my colleagues, of the commitments we make to the way we comport ourselves in the community environment. And in particular, they are more and more determined that we show a responsible attitude in matters of environment, climate change, and all that goes with that as we move forward. So my general point is a simple one. Sustainability is the watchword. It has levels of meaning that have to directly do with a profitable business model, but also with people engagement, and also, above all, perhaps, with responsible commitments to the communities we do our business.
Stephen, what do you see for yourself, for your organization, and the banking industry that needs to be done differently in that, specifically in that last area compared to 12 months ago, to address some of the trust gap that Indra was talking about?
Well, some of this is not new. What went on in the run-up to the crisis was outrageous, has damaged trust in the industry, and tragically, as is so often the case, it is parts of the industry that owe the rest of the world an apology. The banking industry as a whole consists of many, many people doing honest, solid jobs of work, and what I've described to you about what our people want is not something new, but we do need to respond to it very, very obviously and very visibly. When I visit our operations in different countries in the world, I always make a point when I call on the authorities of talking not about the need to be profitable. We do, of course, need to be profitable, but the importance to us of making sure we're making a commitment to economic and social development. These things hang together, and it's critical that it be seen to be so.
Very interesting, in a sense, very much in line with what Mr. Wang was saying just a moment ago as well. And Eric Schmidt, of course, Google has been engaged in some extraordinary innovations economically, but also extraordinary innovations in terms of meeting social needs, sometimes not even well-defined social needs. How do you see this issue of leadership in terms of innovation? And do you see any changes now compared to a year ago?
Well, the question I always ask in these sorts of conversations is, where is the growth going to come from, fellows? You know, what are our choices? What are, you know, are we going to move all the money around again, or are we going to create something new? Innovation is fundamentally how the world's going to become a better place. Innovation in healthcare, innovation in information, innovation in governance, and so forth and so on. So in Google's role, we see ourselves as basically focused on the end user. And our internal view of ourselves is that whenever there's an opportunity to provide something at low cost, or ideally no cost, to an end user, you know, paid for by advertising or other mechanisms, that's a win, because then they have a choice. They have an opportunity to do something with that. And the most interesting thing that's happening in the Technology Center has been the explosion of mobile devices, which everybody knows about. What people don't appreciate, in my view, is that these mobile devices are more than phones and cameras and so forth. They're the most powerful computers you've ever held in your hand, and they're connected to the most powerful set of servers that have ever been developed. And it is the combination of that that really will drive things forward. You can literally know everything, know where people are, know what people are doing, analyze questions, translate every language into every other language, take pictures and figure out what they are, have something called augmented reality where the phone will show you what's going on as best we can tell behind the images. You know, it's all in a device of this size. So that, to me, drives so much of the dialogue going forward, because it is a big change. It's a change of empowerment. Mm-hmm. So innovation drives change and wealth, in my view. Where are the jobs going to come from? They're going to come from innovation in all of the industries we're describing. And second, the innovation that I'm talking about is an empowerment about individuals. And that spreads from the standpoint of self-interest, business productivity, all the things we normally talk about. But it also allows individuals to make their world a better place, to know more things, to decide which crops to plant when, all the things that people care about in their daily lives.
Rosabeth, listening to this panel here, talking about the role of business, not on the economic side, but on the social side, idea of a positive engagement with governments on some of these issues, the example of China Mobile, the examples of HSBC, and then the very forward-looking perspective of what Google's looking at. I mean, it sounds great, but it doesn't sound at all like the kind of things we've been hearing in the media in terms of the debate around the role of business. So, you know, you as a business professor have been looking at these issues. What do you see actually as the trade-offs here? I mean, how real is this? And what do you think people should be taking away in terms of what business can actually be doing coming out of this recession?
So I think it's very real. I think it's not always happening, but it can be, and it can make a huge difference. So I have been working for the past 4 or 5 years on a set of companies from all parts of the world, every continent in the world, that were considered exemplary. I chose them 4 or 5 years ago because they fit models like this. They had strong cultures, and they engaged with society, and they're some of the world's leading companies. And I can give you the good news that they generally outperformed their industry peers, and sometimes by a large amount during the recession, because they had these attributes. And we've got to get these attributes recognized as legitimate, where sometimes laws don't allow this, get them taught at business schools, get CEOs honored for living up to them, and they've got 4 characteristics. The first is that an enterprise has to be defined in terms of how it serves society. That's the definition of the enterprise. From that does follow shareholder value, because, as I said, these were very profitable companies that I've worked with, and they're some of the world's leaders. Some of them are sitting on the stage, but it's also IBM, Procter & Gamble, Banco Real, Santander Brazil, Cemex in Mexico, Omron in Japan, et cetera, et cetera. So they do it first by defining their mission as serving society and creating, out of that sense of purpose and value, something that integrates the enterprise around what it's doing. So that, first of all, turns out to be very efficient. When you have far-flung enterprises, if you don't have your people who have to make fast decisions on the ground on the same page with respect to what are they doing and what are they doing it for, you can't make good decisions. And so in many of these companies, they are very fast because they invoke a common set of standards and frameworks. And by the way, those standards and frameworks, they often use in countries other than their own to try to raise the standards in those countries. So, for example, Procter & Gamble was heavily involved in helping create the first health maintenance organization in Egypt so that they could treat its people, their people, the same way in every country of the world, have one integrated enterprise. The second thing they do is innovation. Eric Schmidt is so right on, and of course Google's performance demonstrates that innovation is always the way you make money. Innovation is also the way you serve society. I mean, in this era when NGOs are all over companies, many companies that they say they distrust, but they still would like their contributions from the deep pockets, actually, the best contribution companies can make to social well-being is through their innovation, through their capabilities to create new solutions to problems. It's nice to have a little extra cash to give away too, but it's innovation. And those companies that have society at the center look further at unmet needs. Eric said, where's the growth going to be? Well, China Mobile realized it was in rural areas. The growth is going to be in places that have needs that are not yet defined even by a market. And the more you can innovate to meet those needs, so the more you focus your people in a company on the needs of society, the more they're going to bring back ideas for products and services that use your capabilities that make a difference, so you get an innovation advantage. Third, you get a partnership advantage. And no company succeeds in the world today, however small, without being part of a network of other companies. We sometimes call it the ecosystem. I mean, how you develop underdeveloped places is through community organizations, it's through business partners that might be small enterprises. And when a company is oriented toward the wider ecosystem and how everyone's going to get some benefits, they attract the best partners, they get those partners wanting to innovate with them, and their reach extends. You often get into new markets better because you're partnering with local organizations and you're helping support them. And that's one of the ways, by the way, the great global multinational company gets in with government, is by showing government that they actually are doing good on the ground in that country in the interests of that local community. And then the fourth thing is the people, and everybody here has stressed the people. These days, there is a value shift. There are young people, the most talented people, coming out of universities and MBA programs. They have values and they want to act on them. They are more engaged if they have an opportunity to feel that they're contributing to something that makes a difference. So I saw in these companies, and I now argue for, the fact that everybody has two jobs. One job is do my job. The second job is change the world. That is, the more the company is able to take on an issue that's relevant to the company's purpose, whether it's climate change or health or education, and give their people a chance to actively go out and contribute to a solution to that problem. First of all, it's a better way to train people to be leaders through service. Secondly, you hire and retain the best people. Third, you get those innovation ideas. And then when you use social networking technology to allow people to communicate about that all over the world, you have a better basis for a positive and productive conversation. And again, you're integrating the enterprise around the sense of purpose. This is why companies that operate this way and that emphasize their culture actually do make more money. Now, you asked about trade-offs. They sometimes don't make more money tomorrow because they have to invest. On the other hand, we consider investment in R&D, bankers consider this, a good thing for companies to do. We also have to put investment in social R&D on the same page, where you don't expect a return in a commercial sale instantly, but you're paving the way for the future. And so I think this is the right economic model. I think the issue is, are enough companies going to do it? Because it requires leadership, it requires trust in people, it requires values, and I want to know whether everybody is going to step up to that challenge.
Well, listen, we're going to open it up to the audience for some questions and comments on that. Before I do that, let me just turn to the panel members. Would anybody like to comment on what they've just heard over the last few minutes? Indra?
Well, I think the only thing I want to is apologize to my friend Stephen Green, because last time when we were on this panel, Stephen, I drew a very strong line between Wall Street and Main Street. Over the last year, I guess I've grown up, and I think Main Street can't do without Wall Street, and I don't think Wall Street can do without Main Street. So we are totally interdependent.
The latter point is true.
We're totally interdependent, so it's critically important we work together to restore faith in corporations, because nobody's going to paint us differently, and we need each other. So.
I entirely agree. I think there's a collective interest in getting this right. The collective interest, by the way, is very broadly defined. The collective interest is the public authorities. It is businesses, both in the real economy and in the financial world. It is, of course, also people. There's a very broad sense in which there's a real common interest in getting this right. Can I make just one other comment? This is about innovation. I'm intrigued. By the way, Eric said, that innovation is at the centre of taking business forward. Banks are often accused of having too much innovation. In fact, they certainly have been accused of being rather too innovative of late. And a little bit more kind of boring return to basics is felt by many people to be the recipe for stabilising and strengthening the banking system. And indeed, Paul Volcker has famously said that the only innovation that banks cooked up over the last 25 years that was any use to anybody was the cash machine. I haven't had a chance to take him up on this, but I think you could argue that there are some financial techniques that are actually really rather important to social and economic development, to corporate funding and so forth. But there is a sense in which the imperative for the moment in the case of the banks is to get back to some basics, rather than think of being rather than producing yet more cleverly innovated financial structures. But that's a rather specific issue for the banks.
Let me just, before going to the floor, ask this question. Why, if there's a sense of the opportunity through innovation, whether it's in terms of mobile devices helping to deal with health issues, helping to deal with empowerment of poor folks in emerging countries, or in fact helping to empower individuals in developed countries as well, all these positive elements we've been hearing, and yet we started off with trust in businesses never being lower. And the conversations have perhaps in some ways never been more strained. How do we match these, and how do we resolve these gaps?
I think, Robert, my perspective is that many, many corporations are doing very good things to help society, to make sure everybody's sustainable. I think corporations are doing that. But when you have one problem that has profound implications, profound negative implications on society, people forget all the good things. And people focus on the negative. I think we've got to restore confidence in the fundamental functioning of corporations so that we can get credit for everything else we do.
So trust is low in business throughout the world, but it's lower in some countries than others. And some of it has to do with, if I can tread on dangerous ground here, with a sense of equity and fairness. So you started out by invoking Peter Drucker. I had the privilege of writing a centennial article about his work. And it was in the 1980s when he started to say that the ratio of top executive pay to the average worker pay was already too high in the United States. And then it was something like 40-1. And it rose in the 2000s to a high of something like 500-1. And the question was more value being created, and for whom because of that? So there are differences in systems around the world. So leaving aside the banking crisis, in a world where, in fact, we need the brain power of everybody and social networks predominate and innovation is important, one question is, where are the benefits going, and have we been a little out of balance? Europe has been different from the United States in terms of recognizing a triple bottom line in terms of reporting, and you get some credit for your social and environmental performance and not just financial performance, but you know, that's really one of the reasons why trust is low. And also, by the way, big companies are not necessarily net new job creators, especially in tough times, but they have to be seen to be creating jobs through their partner network, through their supply chain. And that message is not quite out. And I think companies also should step up to the challenge of saying, we have our family. We are not just the corporation reporting to these shareholders. IBM, for example, Palmisano says we have 400,000 employees. We have 1 million if you count a whole range of business partners, and it's probably a lot more if you count all the business partners, cloud computing, Google, etc. And once you add that up, and if they are taken seriously and have a seat at the table, you then see a company like that as a net job creator and a supporter of economic development, even when it's not coming back just in the pockets of their own shareholders. I know shareholder value is important for listed companies, but the question is, what's the balance of responsibilities, and what about day trading there? Are those owners or not?
Mr. Wang?
In terms of innovation, I mean the technical innovation and not financial innovation. I think one of the important issues is to let the investors, the customers, and people know what the innovation will bring to them. And so I think the communication is very important. One example is about the green action. We say every company should take the social responsibility for the reduction of energy consumption and reduction of emission of carbon. And when we talk about that, we always mention the responsibility. But some people always think responsibility means to pay more money. That's the responsibility. But if you use some new technology, we can reduce the emission of carbon, but we also can reduce the OPEX and CAPEX for corporation. If we have a lot of examples. We can use IT technology to make contribution to the carbon emission reduction.
So the power of the and, actually really focusing on innovation to get economic returns and also some of the social returns. Let me open it up to the floor now. Do we have the microphones here? Here's the rules that we're going to be using here, which is I'd like you to comment for 30 seconds. So you can say what you want in terms of a statement or a question, as long as it's not more than 30 seconds. And if it is much more than, I will just have to cut you off. And also, these are interesting organizations with corporations that are doing interesting things in terms of products, financial results, strategies, none of which are relevant to the specific issue here. The issue is about business leadership broadly. So if you have a company-specific issue, I'll invite you to actually ask that outside. If you have an issue related to the topic at hand, in terms of a question or a comment, it's extraordinarily welcome. Please. Who would like to speak?
Yeah, I have a question. First to Stephen Green and maybe to the others. You've talked about moving and the need to move from the shareholder model to the stakeholder model. I'm curious how you communicate to your board. You know, in the old shareholder model, you're able to talk about your financial performance at every board meeting. How are you talking about to the board in a stakeholder model, and are they fully supportive generally in this transition?
Could I ask you to introduce yourself quickly as well?
Doug Michelman with Visa.
We talk about financial performance at every board meeting. As I said, I think financial performance is still pretty important. But we do also talk about the other things. We do also talk about people engagement. We do regular survey work on that in all sorts of different ways. We formally report that and discuss it at the board. And we talk about our policies for corporate sustainability, corporate social responsibility, or whatever you want to call it. And the general point is the one that I've mentioned, that I think these things are not different things in the sense of incompatible objectives. On the contrary, they're interdependent, and you will not achieve the first one on a sustainable basis unless you're delivering on the others. So I don't think this is a blindingly new thought, at least to our board. This is the kind of long-term way we've always tried at our best. We don't get it right all the time, but to think about the business.
Go ahead, Mr.
I have an example. You know, several years ago, the management team of China Mobile wanted to create a charity foundation. We tried to use some of our cash for the charity, but we didn't mention that in board meeting because it would reduce the value of shareholders in near term. But we were very surprised. The independent directors, people always think they are representatives of minority shareholders. They suggested China Mobile should set up a foundation for some charity and some other causes. So I think most of the investors and our independent directors, they know the long-term interest is very important for the company, both for the majority and the minority shareholders.
So I've been thinking about the financial innovation question, and in this context, you could think of the financial crisis that we went through as a combination of a misalignment of incentives, regulation that didn't catch up with products, and some products that were just wrong. Some of the risk models and so forth, which contributed to these huge failures, were mathematically just wrong. It was just a bad product. There are so many other things in the financial market where innovation makes a huge difference. The most obvious ones being the development of new forms of credit and debit systems, which you know very well about, which change the situation for people, millions of people, when they show up. So you combine that kind of innovation with the development of these new mobile devices and the kinds of things that you can do where you can take a picture of a UPC code, you know, on a bottle, figure out if you want to buy it, using a payment system from your local bank, and keep the money on the phone and buy it and have it delivered as soon as possible. These are huge economic drivers for growth and innovation that are good things for people to be working on.
Question right over.
Hi, Jim Breyer with Accel Partners. And a question for Eric and Dara, anybody who would like to ask. You are all clearly leaders who have a genuine view that you're part of some larger social good. I'd be interested in some specific policies, whether they're compensation policies, financial policies, motivational policies that you've implemented as board members and as executives that have really made a difference in furthering your company's goals while at the same time balancing the social responsibility.
Let me take that. You know, the objective of the code of conduct for the company is under a statement which we call performance with purpose. And it's not performance or purpose, performance and purpose, it's performance with purpose. And the way we've defined purpose is not corporate social responsibility, because our fear was in tough times, we might cut those investments. So we define purpose such that if you don't deliver purpose, you can't deliver performance. So example, purpose one was, how do we transform our portfolio so that we provide healthier products to consumers, and then provide nutrition education and put kids back to an active lifestyle. So that was embedded in the first plank of performance. The second plank of, purpose. The second plank of purpose was environmental sustainability. We set goals for every plant on water reduction, energy use, greenhouse gases. And then the third plank was our workforce. How do we make sure our workforce remains the best in the world? So what we did was we took all of these metrics, hardwired it into the incentive system, and hardwired the portfolio transformation into our long-term stock option program. So if you don't meet those goals, you don't get your stock option payouts. Okay? So it's not just short-term performance, it's critically important, but the purpose initiatives have to be fulfilled for you to get your annual bonus, for you to make your performance goals, because we cannot keep delivering great returns if we don't transform the portfolio and hold on to our people. So we've linked these so intricately that I feel comfortable that long-term goals that are more society-oriented can in fact impact performance.
Great. Other comments on what concretely is different?
So here's something, again, I'll give you an IBM example, because concretely different is the idea that you can market differently, have a different conversation with your customer if you start out with a social good thing. So they had a breakthrough in grid computing, and it was hard to explain to customers why all that data processing would help them. So they set up a not-for-profit called World Community Grid, gave away that computing power to the world's biggest scientific projects, looking for cures for AIDS and cancer and mapping rivers for the environment. And that was like product sampling, which I'm sure PepsiCo does too, but product sampling on a huge basis, saying if we do something good for the world, we now have a way to demonstrate to our customers what we're capable of doing. And it's a better conversation than to walk in the door saying, I want to sell you something. Instead, look at how this product is making a difference in the world. Now can I sell it to you?
But let me continue with this issue of what's actually different. If you have this organization that has performance and purpose ingrained, what's different compared to that organization before, or different compared to organizations that perhaps don't have that dual view? Aaron?
The biggest difference is that your employees now have infinite sources of information. And as a manager, you manage your employees, and they read the press, they read the criticism, they read the analysis quicker than you can talk to them. Mm-hmm. So management today is materially different because of the information empowerment of the employees. And it means that a lot of the debates that occur inside of a company fundamentally have to take that into account. How are we going to be perceived? This drives, Elizabeth, I think, did the best possible description, that you get better shareholder returns when you are doing something to make the world a better place. And as long as you're coherent with that, you'll be fine with your employees. When you start doing things which are inconsistent with that goal, it's almost impossible now to keep your employees, quote, under control in the old model.
That's great. It looks like our element of improving the state of the world could be adopted as more broadly. Stephen, did you want to comment on this? And I'm particularly interested in this issue of, are there things that are different in measures or metrics or approaches compared to, say, 5 years ago or compared to other organizations in your field?
I wouldn't want to try and compare us to other organizations. I think that's a bit invidious. So, I mean, our journey, and I guess for all of us, if we're honest, we're on a journey, and anybody who claims they've got it all right all of the time is kidding themselves. But a couple of specific examples for to answer the question, i.e. initiatives that we have undertaken because we think they are good for business over the long term, but also very clearly have a social responsibility dimension. I'd name two things. One, we started rolling out rural banks in China. Actually, we started the year before last. We've continued to evolve that. We now have, at the current count, I think I'm right in saying 7 different banks. They're all rather small, they're all new. They will make money. We have to be clear, we haven't done this because we think this is a purely charitable initiative. These are businesses that will make money. We've done them with the encouragement and the blessing of the authorities, because the fact about banks is that almost anything you do almost anywhere has to have the blessing and the encouragement of the authorities, but which we've definitely received that. So that's one example. And another example is the area of environmental sustainability / climate change, where we, and other banks are certainly doing the same here. This is absolutely an area where I wouldn't even want to be distinctive. You actually want other banks to be doing the same sort of thing, have been evolving sector strategies for particularly sensitive sectors, forestry products, water resources, chemicals and so forth, where you evolve a series of policies for how you will engage with your clients with a view to the two of you together, the bank and the client, becoming more sustainable, if I can put it that way, with the overall objective, not of cutting off the relationships because you don't want to do business with them, but on the contrary, finding a way of doing business that both of you are comfortable with in climate or environmental terms.
Great. Let's go back to the audience. Right, the gentleman right here.
My name is Masaki Omura. I come from Japan Bank for International Cooperation. My question should be addressed to Mr. Green. I agree with your observation of the corporate model should be sustainable. But the key question is the standard of sustainability. It might be different from that view of general public. For example, general public thinks like small and medium-sized enterprises. If banks can continue to finance, it can be sustainable. But banks tend to think, no, it cannot be sustainable. You should stop. Then general public should accept bank's judgment, or is there any different way?
If I understood it, the issue is about lending, particularly, I think you mentioned small and medium-sized enterprises, and banks sometimes taking decisions to stop lending or to not make a loan in the first place. Those are, of course, rather specific decisions that have to be made. Banks, and I don't want to sound as though I'm coming across as banks always get these decisions right. Manifestly, that's not true.
Depends on the model.
There is plenty of evidence at the moment, if you look at the impairment line in banks, that they make mistakes in their lending decisions. Overall, of course, it is in the interests of a bank, and actually I think in our collective interest, to lend where you think you're going to get the money back rather than where you don't think you're going to get it back. And you do need, socially we need, to ensure that the lending market and indeed other bank services markets are provided on a competitive basis so that there is no excess price being charged. The fact is, in some countries at the moment, we are all having to get used to, how can I put it, a reversion to a prior norm. There was a time in the early part of the last decade, or this decade, depending on when you count this decade, whether you think this decade is finished or not, in the middle years, when there were examples of banks lending on terms that became increasingly lax, for want of a better word, where the pricing got finer and finer, where the conditions got weaker and weaker, and in the end you got the result that we got. So we really do need to expect banks to be lending on a responsible basis, and the responsible basis means pricing properly, lending on the basis of proper risk analysis, and sometimes that simply does lead to some uncomfortable decisions.
We have time for one more question. At the back.
My name is Hussein Dawood. I'm chairman of the Karachi School for Business and Leadership. I'd like to ask the panel, what is the role of the boards in re-establishing trust in corporate leadership?
Who would like to take a shot? The role of boards in restoring trust in corporations.
It's a tough question. I'll tell you why. Because boards are supposed to provide oversight, and if they'd provided the right oversight of all of the enterprises, perhaps we wouldn't be in the position we're in today. But herein lies the conundrum. As companies and businesses get more complex, and board members, spend a day or two at a time on a company, who is really running the company? Boards can't become the management of the company and try to get deep into the company to try to understand every aspect of the company. So I think the best the board can do is make sure they have the right CEO in place, make sure they have the right management, make sure the company has the right code of conduct and values, and then hope that all of those come together to make sure the company stays, a highly ethical and moral company. If we try to extend the role of the board too much, I think we'll have too many bosses, total paralysis, and I'm not sure we'll restore trust in companies.
We've had a great conversation in terms of going beyond the defensive issues of what you do to make sure corporations don't actually cause financial and economic problems, which is a critical issue, but is only one of the parts of how do we actually have corporations be one of the agents for innovative and positive change, both economic and social. Let me just go through the panel and say, with the audience here and the audience watching, are there any last points or comments that you think are important takeaways? I'm going to end up with Rosabeth. Maybe I'm just going to go right down the line, if you don't mind, Indra.
Start again. The one message I'd like everybody to take away is that you need private enterprise to spur economic development, spur job creation, be the engines of innovation. And I think the time has come to stop talking and acting about public-private partnerships, to get all of the negativism about the private sector behind us and start working within a framework that makes it possible for us to stop having these ugly debates between the two of us, to stop having excessive paperwork and regulation imposed on private enterprise, and let's just get on with the business of innovation, job creation, and really functioning as the engine of economic development.
Mr. Wang.
I like to say the Great Recession created a new business environment. As management team, we cannot change the business environment, but we can do the management thing better. For example, we can make the company more transparent, and we will pay more attention to long term.
In thinking about the choices, if you're a large company, you need to have an innovation agenda. And many large companies are still run as though they're essentially structured the way they were when they were founded so many years ago. And innovation applies in every one of these businesses, whether it's a service business or any kind of material goods business. Innovation in delivery, innovation in science, and so forth. If you don't know what that is, I don't think you're doing your job. This is a great time to be starting a small business, because the government and the regulators and the banks will figure out a way to get lending going again. And this is precisely the time when asset values are low and opportunities are greatest. And the reason it's best now is because globalization has created an ability to have a very fast path of growth. No longer is your customer just the local city or the local town. You can think of yourself as a player on the global stage. You can get global distribution, global branding, and so forth at a cost at a fraction of what your predecessors did. So there's every reason to believe that if big companies focus on literally innovation in their businesses, trying to create new things, and little companies get formed, we can solve the problems that we have before us. If we don't, the new normal will be flat, and the world will get really, really boring.
I'd like to conclude actually by trying my answer to that last question. Because I think boards have an important role to play, indeed a critical role to play, because I think we all recognise, Indra said it and I agree, that a key responsibility has to do with the nurturing of the corporate values, making sure that those are indeed nurtured and spread by management through the system. And the only way of doing that is for boards to pay constant attention to that question. Regulations are with us. The regulatory environment for banking is clearly going to get more intense. It frankly should get more intense. There are some lessons for regulators to learn, but it should get more intense than it was going back a few years. But regulations, they may be necessary. They're absolutely never sufficient to ensure right behaviour. What is necessary, in addition to whatever regulatory environment you're in, is boards that are focused on the long term, the value of the services delivered, and the values which are spread through the organisation.
Rosabeth.
So I think we still need all the management disciplines, but what we're hearing is it's a different world. It's turned inside out and upside down. I mean, inside out, because we have to pay attention to the voices of society, but yet they are also the sources that could stimulate creativity and open new markets. So we have to be much more attuned than companies have traditionally been to the outside world. Bring in those voices, listen to those voices. I always wonder as I go to gatherings of the top management of big companies all over the world, why there are no customers in the room, or why there are no customers who are not customers yet, but you'd like them to be customers. So outside in, and the other thing is we have to think a little upside down. We know our world's been turned upside down, but upside down in the sense that people at the top have to listen to the voices of the people at the bottom. Those networks are incredibly important. We need their engagement, and that we have to stimulate their imagination. We have to be nurturing those who are the future of the company and give them a much more important role in defining it. And then that plus, by the way, business only operates well. We've talked about regulation and the heavy hand of government, but it only works well when governments are themselves open, transparent, disciplined, and not corrupt. So business can't do it alone, and enterprise is a way to solve important problems and enhance our lives. And for that alone, we want businesses that stimulate openness, transparency, and imagination.
Well, I think that was an inspiring but challenging panel. I mean, in the sense of showing that businesses can actually make a very positive difference, not only economically but socially, but that it's challenging for the CEO and the team because it's actually requiring a much more complex, multifaceted agenda, and it is acquiring the willingness to actually take some short-term hits to achieve these things in the long term. I mean, what Rosabeth and the others are saying here is actually over the long term that can have enormous positive economic as well as social benefits. And that's real leadership. And that's the kind of leadership that will maybe not only restore the economic but also the trust balance sheets of the private sector. Please join me in thanking this panel.
Okay, I'm going to get